Hi, Billy. I'm Chris.
How you doing, Chris? All right?
I'm sweating it out here, mate. It's we don't often get weather like this in the northeast, but it's 25 outside, so yeah, but it's very, very nice. I promise we'll keep this short.
Yeah. Well, okay. Well, I don't need to do any introductions because you can see Chris and you can see me. So welcome to the webinar. As I said, the webinar is being recorded, and just some basic rules. If a smoke alarm goes off and you can hear it, then you need to act on it. You know, you're not in a room with us, you're at home or you're in an office. So just remember that. Any questions that you've got, it would be useful if you could just write them down as we go through the webinar. And then there's plenty of time at the end for us to, talk through, answer any questions. And so say them until the end. So Chris is going to do the bulk of the work on this. So I'm going to hand over to Chris and we'll move forward from there.
Great, thanks, Neil. Right. Well, good afternoon. As Neil said, it's a very select group this afternoon. And given it's pretty hot and sticky out there, we did a run through on this yesterday and we've done it in about 20 minutes. That's without questions. So if there's anything that grabs your interest, then just make a note and we're happy to stay on as long as need be afterwards. So our thinking in preparing this is really to, as part of our strategy at PT360, and that is to provide as much support as we can to investors on the journey. And holiday lets is one of a number of opportunities which we think is worthy of further attention. I was reading this morning, I'm sure we're all sick and tired of the news and we're acutely aware of this cost of living crisis. But I read this morning that some guy posted on LinkedIn, you might have seen it, and he was saying, what inflation actually looks like. And he was comparing the price of a number of items that we buy on a regular basis, and how the price has changed from January 2020 up to the current date, so over a 2.5-year period. And gas is up 233%, wheat is up 111%, and oil at 79%. And these are costs which are pretty difficult to avoid. And of course, for those of us in the long-term buy-to-let market, we're already aware of cost increases thanks to the changes to finance cost relief, which Mr. Osborne brought in 2015, which became effective in 2017, and of course, which really bit down hard in April 2021. So we're going to have a look at holiday lets and why we think it's worthy, if you're not already in that space, of having a closer look at them. Slide, please. So we'll do a quick intro into us. That won't take too long. We'll look at the main advantages that furnished holiday lets have over buy-to-let. And then we're going to talk about some opportunities. There was a survey in one of the newspapers a few months ago where they'd asked about 1,000 of their readers what were their aspirations post-pandemic. And 60% said they had intentions or aspirations of getting out of the dreaded 9 to 5 and setting up a business which would, give them that all attractive passive income and obviously greater freedom and the chance of building a lifestyle of choice. So whereas you both are probably existing investors, but you may know of people who are thinking about it but not really sure where to make a start. We'll briefly cover ownership options, which of course has a direct impact on our taxes. We'll also touch very briefly on a couple of other important issues, one of which is how to keep more of the profit that you make. And given those numbers I quoted before on inflation, I think that's quite important. We are planning on doing a separate webinar on item 3, probably the next few weeks. We'll touch on legacy, which is obviously important, and the roadmap, which is how we help members get from where they are now to where they want to be. So slide, please. Property Tax 360. We believe in socially responsible tax planning. So what does that actually mean? It basically means that we should all pay the right amount of tax and on time, but not a penny more. And we do that by making sure that we adhere to both the law and the spirit of the law. The spirit of the law might sound a bit of a strange one, but in recent years, our friends at Revenue Customs have had quite a bit of success in persuading the judge to accept that though the plaintiff may have acted within the law, it was perhaps against the spirit of the law. So we're very, very hot on that. But there is a paradox which says that you don't need to go looking for loopholes. The rules themselves provide pretty much everything that we would ever need, and that's our philosophy. And we do that by working closely with HMRC. So rather than trying to find loopholes or getting constant arguments or butting heads, we prefer to work with them. And subject to the planning that we talk to our members about, we either get clearance from HMRC or pre-approval. And I think whoever you are currently taking advice from, I think those should be your basic de minimis positions, because the cost of not getting it right at the beginning is increasing all the time. And we can talk about COP 8 and COP 9 inquiries another time. There was a survey, I'm big on surveys, as you come to recognise, recently from the Office for National Statistics, and I think it was compiled in April this year, and it was dealing with the investing habits of the great British public. And there's two numbers there. The 5% relates to those of us who invest cash with financial advisors. So we buy ISAs, we buy investment bonds, we buy their kinds of pensions. And the reason why I mentioned the 5% is that 5% is looked after by 58,000 regulated firms, regulated by the Financial Conduct Authority. And that 58,000 firms employs 2.2 million people. I mean, that's one hell of an industry. The 39% relates to those of us who actually invest in property. And though we don't have any official statistics, we believe that there are fewer than 200 specialist property advisory firms dealing with the 39%. That's quite a mismatch, I think we'd all agree. Legacy planning is, of course, important. We often ask the question when we're having one-to-ones with members and other investors, why did you go into investing in property in the first place? And of course, it's to make some money, but also to leave something to our loved ones, leave our life's work to our loved ones, and ideally leaving 100% of our life work to our loved ones. And we do that by ensuring that all reliefs, exemptions, and allowances are available and claimed, because a lot of these things we don't actually, claim. And if our professional advisors aren't aware of how to claim those things, oftentimes they can go be missed. One example of that is, making a will. I was talking to a guy earlier this morning, and he was saying he had a meeting with a will writer, and I asked him for basic outline of the will that was on the table, and it's where he leaves everything to his wife and vice versa. And I pointed out that was wasting wasting a nil rate band of £325,000, and that by doing the will more effectively, they could make use of 2 times the nil rate band. So it's very simple things that can be done. There's obviously more technical aspects to legacy planning. It depends on where the investor is in his or her journey. And I've mentioned the accountant there, and it's really to say that we are more than happy to work with members, professional advisors. I saw something on, I think it was LinkedIn earlier in the week, where somebody asked the question, can the accountant be a tax advisor as well as an accountant? And of course, the answer to that is yes. But we find, based on many, many years of experience, that the accountant has to wear many, many hats, often most days of the week. And it's very difficult when someone is working in that kind of arena to specialize in a certain area. So for example, take the example of the GP. If you've managed to find the lesser spotted GP, you'll know that the GP will do a basic assessment But if there's something that the doctor's not really sure about or thinks it needs, specialist attention, then we are referred to a consultant. So we fulfill that role as being the specialist consultant. But as I say, happy to work with the accountant and, of course, the lawyer and anybody else that you have in your respective team. Thanks, Neil. So we'll run through the main advantages of furnished holidays over buy-to-lets. We'll have a few minutes looking at the qualifying rules, the rules that HMRC require for us to make sure that the holiday is compliant to achieve the tax concessions. We'll touch briefly on the staycation explosion. I think anybody who's seen the news in the last few weeks and seen the strife at the airports will see why that's perhaps an issue now. And then we'll focus in on the core tax benefits of holiday lets over buy-to-lets, and then touch on why it's good to diversify, and obviously how we get out of everything at the end of it, how we fulfill our objectives. Slide, please, Neil. So the qualifying rules, pretty much all encompassed in that revenue, that government.uk web address there, HS253. When we started looking at this a few years back, we see that a lot of firms who purport to be experts in this have just cut and paste all the revenue rules. But it's a good place to start, a good place to be familiar with it. But the highlights are that, believe it or not, HMRC insists that we must intend to make a profit. Seems a bit obvious, but I think that is really aimed at those investors who are pretending to have a holiday let, but actually they've just bought themselves a holiday home. I think that's what that's aimed at. Michael Gove recently announced that because of that holiday home issue, that from April next, anybody with a second property that purports to use it as a holiday let must let it out for at least 70 days a year to avoid paying council tax. And instead of paying council tax, access small business rates relief, which we'll come on to.
But we must recognise that with that one, though, Chris, is that in the Social Republic of Wales, which affects Sarah, they are being a lot more strict in terms of the rules, and there's a lot of holiday let owners a little bit up in arms about the approach that they're taking.
Do you feel it's heavy-handed, Neil?
I think it's very heavy-handed.
Okay. Any reasoning why? Have they given any indication why they're taking this?
They're just trying to discourage ownership of second homes and trying to create, in the belief that if we up the restrictions or the requirements in order to qualify for small business rate relief, then it will discourage people from buying second homes, and we will have homes available for first-time buyers.
Yeah. Okay. Right. Okay. I can see that. Okay. Moving on. The Revenue and Customs require investors to provide suitable proof that they are intending to profit, that it is a property available to be let. So examples of how we might do that would be via, say, a website or a brochure. We would confirm letting details, perhaps using social media, and of course keep records, receipts, etc. Quite a few people we're talking to at the moment are using agencies, the Airbnb lot, to manage their lettings. They take a fee, but it means that all bookings are centralised, and there's not a lot of work to be done by the investor except to collect the net rent. And property must be within the European Economic Area, which includes, incredibly, Iceland, Norway, and Liechtenstein. The 31-day rule is applicable to lets whereby, let's say somebody wants to take a property for an extended period of time, say about a month. As long as they don't exceed any number of lets on that basis for more than 155 days or basically half a year. So again, it's all about keeping records. We assume that accountants are on the ball as far as this is concerned. Property must be available for at least 210 days each year, but it must be actually let for 105 days. And again, Neil mentioned the changes taking place in Wales. This applies to England and Scotland. Now, bearing in mind the last couple of years, I think it's important to point out that we're all hoping and praying that we don't have a repeat of the last couple of years. But if for whatever reason there was a problem with those numbers, there are a couple of options or elections using self-assessment that we can fall back on. So, for example, if we have more than one property, then we can average out those numbers over the properties that we have. And if it's just the one, as long as those numbers are achieved in some years, possibly not all, then the revenue will grant this period of grace and not take action. Next slide, please. Okay, so the main advantages of buy-to-let investment. The wholly and exclusively rule is something I think that all business owners really should be aware of. And the full line of that is wholly and exclusively for the purpose of the business or trade. So in other words, any expenditure which is purely that satisfies that rule, then that expenditure should be allowable as far as the holiday-let's concerned. That does not apply to buy-to-lets, especially if we're claiming the property income allowance of £1,000 a year and where the expenditure is revenue-based rather than capital-based. So what expenditure are we talking about? Well, utilities, waste collection, all finance costs, not just loan interest. Any advertising or agent letting fees, welcome packs, which can be quite expensive, and of course things like maintenance, and cleaning, as well as insurance, public liability, buildings and contents. Then there's capital allowances, and a lot of this is made of capital allowances on social media. A lot of firms out there who are saying, we can help you get capital allowances, which is a form of tax relief. There are two types of capital allowance. There are loose allowances and fixed. Now, the loose allowances are easy to identify. So furniture, furnishings, white electrical goods and electrical appliances. Fixed capital allowances are a bit more difficult to value. So for example, with wires, kitchen units, pipes, plumbing, and replacement doors and windows, the revenue would want to see a qualified surveyor to identify those items and appoint a value to them. But whatever we spend in those areas is allowable against profit in full. So again, that is a major advantage over buy-to-lets. Next slide. A few moments ago, I mentioned about council tax and small business rates relief. Satisfying revenue rules means that we don't have to pay council tax and we can actually apply for small business rates relief, potentially up to 100%, subject to the rateable value of the property. And that's all based on the amount of rent that we can achieve for our holiday lets. Again, we can deal with any specific issues on that at a later date, but it is a very attractive concession. And also rental income is a qualifying expense for making pension contributions, which is not the case with longer term buy-to-lets. With a buy-to-let, if you want to split profit amongst, say, members of the family who've got personal allowances which are not being used, then that's difficult unless those members of the family have a percentage of the property. With a furnished holiday let, that can be done at your discretion, which again is a benefit, a significant benefit. And last but not least, looking further down the line, the point at which we decide to get out. It's concerning at the moment seeing just how many landlords are setting up their buy-to-let portfolios for various reasons, and I'm sure finance cost relief is one of them. But with a furnished holiday let, there is a significant benefit there at the moment, whereby when we come to sell, then there's only be a 10% capital gains tax charge on the increase in value, as opposed to either 18 or 28%. 28% is for higher rate taxpayers. So that is, we think, a significant benefit. I think just to finish off on that section, I think I'd make the following point. None of us knows, where this cost of living crisis is going to end up. what the government might decide to do to provide further support. I was at a meeting yesterday, and the speaker said that, in his opinion, the current government could basically sort out re-election this summer, 2 years in advance, by simply providing the same kind of support now as most of us received during the pandemic. And that's fine, but where's the money going to come from? And I think I mentioned as well that I think it was March 2020, the Office for Tax Simplification recommended to the Treasury that they realign capital gains tax rates with income tax rates. For those of us with long enough memories, when Gordon Brown was Chancellor, in those days both rates were fully aligned. So the top rate of income tax was 40%, so was the top rate of capital gains tax. So far, the government have resisted the temptation to act on that recommendation. But I think given what they've done in the buy-to-let market, I think there's a possibility they may decide to take action at some point with regards to holiday lets. So it might be a case of getting now while the going's good. Thank you, Neil. Next slide. So opportunities. I mentioned at the start about this growing aspiration to get out of the 9 to 5. A lot of property investor networks that have sort of cheekily joined under a different name to hear what's being said have got some great ideas for first-time investors. And ultimately, the idea is to get out of their jobs and to live the easy life of being a property owner with a nice, easy passive income. I'm sure it's not quite the case in reality. But the fact is that I think more and more of us have had time to reflect on our lifestyles during the pandemic. And I think if there was an easier way to make this possible, I think more and more people would do it. And in this area, I think there's definitely an opportunity. When it comes to owning property, the two main options that people are aware of are where people own the property in their own name, personally, potentially through a partnership, which has the same situation. So the top rate of income tax on income is at 45%, or by using a company. And there's been quite a drive in recent years to encourage people to consider the corporate route because of the finance cost relief issues on buy-to-let. But it's worth pointing out that with corporate, yes, there is a lot more tax relief and allowable expenditure, but income profits will be taxed at 25% from next April. And that has to be borne in mind in conjunction with the tax on dividends, which is still the traditional way of extracting value from a company. Dividend tax rates increased by 1.25% April just gone. So it's getting a lot more expensive now to use a company, in addition to which you've got the added compliance costs from the accountancy profession. In terms of getting out, exit, the point I made a few moments ago, currently up to the first £1 million, the capital gains tax is limited to 10% on sale, which is attractive. Keeping more, Neil and I were chatting yesterday, and we've decided to do a separate session on this because it probably needs a bit more than the 2 or 3 minutes that we're allowing for it today. But in simple terms, when we draw money from our profits, whether it's property in our own name or through a company, there's a tax cost. With a furnished holiday let, we are required, as you recall, to be seen to be advertising. And the advertising is aimed at those people looking to book an Airbnb. There are various alternative ways of advertising our properties where the advertising agencies provide a range of benefits to reward customer loyalty. I think we're all familiar with the concept of the coffee shop, where we buy 10 coffees and then the 11th one's free, or you buy 6 and the 7th one's free. That's referred to as a closed loop rewards scheme. Back in 2008, the very first open loop reward scheme came about. And now there's 3 or 4 providers in this particular space. And basically what it means is that we can spend allowable expenditure on advertising, but we can receive rewards in the form of points. And those points can be exchanged for goods and services anywhere in the marketplace. And the points themselves are taxed the exact the same way as a free cup of coffee. In other words, there's no assessment. And that's something we're going to come back to, because we think in the holiday world, this could be of significant interest. Almost done. Legacy, particularly reference to this, and asking, is current planning robust? You may have seen in the news or on social media a few weeks ago about a large estate planning specialist firm in the Northwest, which has just gone into liquidation. The media were interested because this firm had 46,000 funeral plan clients who now don't have funeral plans, despite paying quite a bit of money for these things. And they've gone bust, and with it, all of the planning that's been done by this outfit. And it's just making the point that when we're planning our future, when we're arranging our affairs so that our loved ones are going to inherit everything, we really need to be speaking to qualified specialists. And I'll say no more about that for now, but I think you get the point. The roadmap is something we conceived at the beginning of the year, and it basically deals with all of the above. It's in 2 parts. The first part deals with all those relevant issues, regardless of where the investor is, whether a new beginner, somebody who's accidentally inherited property, and of course the aspirational investor who wants to really make a mark and build a portfolio. And it will cover everything that we need to know. The second part of the roadmap deals with that equally important issue, and that is, well, what does the future look like? Neil and I, when we meet people on social media, on LinkedIn, on Zoom and Google Meet, we pose a question towards the end. It's one which really requires a great deal of thought. So I'll ask the question now. Assuming we're having a meeting, say 5 years from now, and it's a review meeting, and let's say to satisfy me, it's on a beach somewhere, and you've flown me out to have this meeting, and we're sat on the beach with a nice cocktail. What needs to happen between now and 5 years from now for you to be completely happy, for you to say, wow, everything I want, I've now got? Now, most people will naturally take some time to think about that, and it requires careful thought. But our imaginations can be used to the full, because whatever it is that we're trying to achieve, it can be done. And the roadmap is the way forward. It will show everybody, show investors how to get what they want, maximize their returns, and secure the legacy at the same time, and all crucially with HMRC approval. So that's it. That's me done. You're already members of the group. We're available. I think the next slide has various contact details. Happy to have a chat anytime about anything. And as I say, we look forward to working with you on your respective journeys. And we'll now take questions.
Hi, Chris. I've got a question.
Yes, Sarah.
Just on the council tax thing, you said you don't have to pay council tax. Do you know if that's just in England or Wales, and how do you then say to the council tax, this will be service accommodation, and they know all about it? Because I feel like there's not many in my area.
Right. And you're in Wales?
Yeah, South Wales,
right?
Near Cardiff.
Okay.
Let me pick that one up, Chris.
Yeah. Okay.
Because the way that the revenue view furnished holiday lets is that they view it as a business. They treat the revenue treat furnished holiday lets in a very, very different way than they do buy to lets. And because they class it as a business, That's why we get all of these reliefs. Now, because it is a business, then in England, Wales and Scotland, it does qualify, providing you can prove that you are, operating within the requirements set down by HMRC to be classed as furnished holiday let. It does qualify for the business rate relief. But because of the structure now in the UK of the independent areas, Wales have decided that they're going to, in terms of the criteria you've got to go through to get the rate relief, they're changing it, they're moving it forward. And this is all part, Sarah, of this package that the Welsh government are introducing with regards to rental properties. It's their new approach to the rental market.
Right.
Now, it was supposed to come in July, supposed to come in next month, but it's been deferred for a further 6 months. But and they're still talking about what those restrictions are going to be. And one that I can't remember the exact number of days, but I think they were proposing that in order to qualify for not paying council tax and get the business rate relief, you had to have the property rented out for something like 280 days.
All right.
Right. So you do need to check on the, on the Welsh government website in terms of where they're going in terms of the rental restrictions that they're planning to impose.
Well,
Okay,
Sarah, let us check on that as well for you, because we need to be up to date on that. So we'll get an answer at our end and we can compare notes and see we're on the same page.
Okay, I'm writing that down now.
It's disappointing that your lot are taking this action. I think you should move to England, but that's just a personal thing.
My goal is to move back to Bristol, actually.
Yeah, nice place, Bristol.
Well, it's only just over the bridge.
Yeah, no, I've struggled a lot with the Welsh government implementing all these different rules, and it's, you just want to say why is it got to be so different and difficult between, if I'm trying to build a portfolio, say just around holiday lets, then I can't really bounce back from England and Wales because there's different, like Neil mentioned. In Wales, it could be rented out for 250 days. In England, only has to be maybe 120. So for me to bounce back and forth, to have some in England, some in Wales, it's just going to be a bit of a juggle for me. So actually, I'll check out the Welsh government website and definitely look into that, because before I invest potentially in a holiday let, then is it better actually for me to go to England? And it's a shame because I'd like to keep it in Wales, but
I know
they unintentionally push you.
I know it's frustrating. We'll do the same checking, Sarah, because we need to be up to date on that. But I think yes, I mean if the Welsh government are hell bent on making it really difficult, which seems to be the case, then it could well truly kill off the holiday let market in Wales, which would be a tragedy because it's a beautiful country and it's got a lot to offer. But it's if we could understand the thinking behind the Welsh government, it might be a bit easier. But it's almost just being bloody minded.
Right, I've just putting a link into the chat box, which will. Oh, come on. No, it doesn't work. Hang on, let me copy it again. Copy and paste. Right, there's a link in the chat box to a news item that was actually published yesterday. And the proposal at the moment from the Welsh government is that where you're told the number of days your business must be open is 250 days. Number of lettings for your business must reach 182 days in order to qualify for the rate relief. But that gives you a bit more background information.
Yeah, fantastic. Thank you, Neil.
Okay, any other questions?
Yeah, I've got a question. Despite the accent, obviously, Neil, you'll know, but Chris, I'm in unsunny Scotland. It's
Really?
currently overcast. So the fact that you're down south, not that far down south, and you're getting sunshine, I'm very jealous.
Yeah, it's glorious here. Glorious.
Oh,
I don't want the wrong country. That's two of you in the wrong country.
Yeah, okay,
If it was nice
for,
here, believe me, you'd be seeing blue sky in the background. I'd be outside, innit?
yeah, but when Chris says it's glorious, it just means there wasn't any frost this morning.
Yeah,
Yeah,
well,
well,
that's
yeah.
true.
It's 22 out there.
Is it? Wow. Right. So I'm based in Glasgow.
Yeah.
There's been a big hoo-ha with holiday let / service accommodation in city centre of Glasgow. Basically, in October, what they're saying is that there's going to be loads of new rules. I only know a couple of them, and one in particular is that the property has to have its own entrance in order to qualify as a holiday let or serviced accommodation. So just picking up on something that you had in your slides there around the 31-day rule and the qualifying rules and terminology as well. Is there a difference between serviced accommodation and holiday let with regards to HMRC? Like, could I buy a property in city centre of Glasgow in a block of flats that's not got its own entrance, but call it something else, and get a contractor to maybe take it for a year, but then it doesn't mean to say that there's going to be the same contractor in and out of it? Would that then come under buy to let rather than service accommodation? Are you with me?
Yeah, that's a buy to let.
Yeah.
Because again, the HMRC requirement is that
Right.
the lets aren't longer than 31 days.
Right. Okay.
Right? If the let
Right.
is if the let is more than 31 days,
Mhm.
and you've got a number of those, then the total number of ones that run over 31 days should not be more than 155 days.
Right. What about a 31-day rolling contract? No. Right. Okay.
No, you're not going to get away with that one, Billy.
No. Right. So is service accommodation the same as holiday let then for HMRC purposes?
Broadly speaking, it's the same thing. But what you've got to go, the strict thing is going back to, if you want to treat it, if you want the benefits that are offered by the furnished holiday let, then it's got to operate on exactly the same criteria. So as soon as if you have serviced accommodation and you've got a contractor in there, and he's there for a 6-month period, well, that's blown everything out the window completely.
Right. Okay. Right.
So I think what you've got to do is to say, well, look, they look the same, right?
Yeah.
And providing you stick by the rules for a furnished holiday let, then it's a furnished holiday let.
Right.
But as soon as you go over that, then it's either going to move into serviced accommodation, or it's going to move into, if it's a longer term let and you're putting an assured short hold tenancy agreement in place, then it's a buy to let.
Yeah, but obviously with contractors and stuff, you're covering, you're furnishing it, you're covering, gas, electricity, and utilities and stuff like that.
Yeah.
So does that still come under buy to let? And does it?
It's some of the rules, but it's not all of it's not all the rules. They want all of these things adhered to. I think it's because the tax concessions are so attractive. It's I think their default position to try and disprove that we have a holiday let, and they'll try whatever they can.
Okay. That makes sense.
Sadly, that applies to pretty much everything we do. It's why we make a lot of this issue of working with them. A lot of the times they'll publish information, often without fanfare. We tend to find out, later down the line, and it's ambiguous at best. And trying to interpret, we have a team of chartered tax maniacs, and they're not covered at the end of the corridor. But these guys are ex-HMRC. So we have this sort of reasonable relationship with them. And if we're in any doubt, the people we ask is HMRC, and we say, right, what do you mean by
Yeah.
this? And then when they tell us, we say, right, put that in writing, fact,
Yeah.
evidence.
Yeah.
Because we do a bit of work for a firm that does something called dispute resolution. And this is where people are being attacked by HMRC. They're being victims of, tax scheme sales in the last 20, 25 years, and where the promoters of said schemes have disappeared, gone to Dubai or wherever they've gone to.
Yeah.
And the revenue don't care about who gave the original advice. They just want the money. It's a cash grab.
Yeah.
That's pure and simple. And they're not interested in excuses or any kind of defense. And some of the things that we're seeing is quite scary. And I mentioned before about how the revenue now attack. And there's 2 codes of practice, or COP inquiries, that you can send out, COP 8 and COP 9. And a COP 8 is basically where the revenue decided, bless them, they're going to keep this matter civil. In other words, they're not going to try and make it a criminal matter. A COP 9 is where basically they believe that we are guilty of a criminal offence, and they want to send a file to the Crown Prosecution Service, which gets it off their desk, and of course puts it in the hands of the criminal fraternity. And the revenue then like to seize assets, so we can't afford to defend ourselves. And this is becoming so commonplace. Contractors, especially the guys who were working, Aberdeen in the oil fields, who were using a particular type of planning, thousands of them have been caught short by this, and the tax bills they're getting are just absolutely horrific. So we've all learned a great deal the last 20 odd years, and the only way forward, as far as I think we're concerned at PT360, is get that sign off from the tax office before we do anything. It might cost a bit more at the outset, but it'll be a hell of a lot less than having to try and defend ourselves as and when they come to have a problem.
Yeah.
And oftentimes when they do write to us, the letter is either asking questions they already know the answers to, or it's a genuine fishing expedition. How we respond to those letters determines whether we open the door wide open, innocently, or whether we shut them down. And the last person to give those letters to is our accountants, because our accountants take it personally. It's like, how dare the revenue write to my client about this, and they'll react that way. It requires a completely different approach.
Yeah.
So if you, or please, I hope you don't, but if either of you know anybody who gets any of these nasty letters, then let us know, because we can help people in that situation.
That's interesting. Yeah. Appreciate that.
Okay. Any other questions?
Anything else?
All good.
Okay.
It's now 25 degrees outside, by the way. Just checking.
It's just getting warmer. Okay.
If you don't believe me, you can't really see it there.
Well,
But
that doesn't look too bad.
It's not raining.
no, it's not raining. We get 2
It's
types of
lovely
weather in
here.
Glasgow: hot rain and cold rain.
Yeah.
Hey,
Okay.
you're much closer to Greenland, where you are.
Okay.
So I've got to ask Billy, with an accent like that, how does it go
Yeah.
in Glasgow?
Well, say that again.
With an accent like yours, I know I can talk, but with an accent like yours, how does that go down in Glasgow?
Yeah. Well, at first I didn't understand the Glaswegians, but then I don't think they understand me either. So it's just
No.
it's
Yeah. Okay. All right.
Okay.
I'd love to be in a conversation with you and a couple of the Glasgow lads. That would be good.
yeah, lots of. Oh, that's right. When there's drinking involved, then nobody cares anyway.
That's it, see. Eventually, we all sound the same anyway, don't we?
Exactly.
Okay. Well, you know where we are, guys. So any questions
much.
as you move forward with Furnished Holiday Lets, we're more than happy to jump on, follow-up calls with you.
Great.
And
Thank
even,
you.
Okay.
and even if it's looking at your existing portfolios, because if you're into buy to let, you'll be acutely aware of the implications of finance cost relief, and there are remedies to that, and we'll happily talk to you about them on a Zoom call without cost or obligation, just so you know exactly what you can do. Not saying you might want to do anything, but at least being fully aware. So I mean, make use of the membership. It's there for a reason.
Okay. All right. Cheers,
Appreciate that.
guys. Okay.
Bye.
Bye-bye.
Thanks very
Bye.
much.
Okay.
See
Bye.
you.
Bye. Bye.